All right, I think I'm going. This is market update for June 2022. Um, as you can see right away, 55% of the stocks in our basket are above their 200-day and 49% above their 50-day. There's been a lot of talk concerning recession and this sort of thing. As far as the economy goes, that's one thing. As far as the stock market, that's another thing. And as far as the stock market goes, I just don't see it yet. When you have half of the companies above both their 50 and their 200-day, that's a decent market. It's a decent place to be. Doesn't mean that all of the sectors are doing great, but enough of them are that we're able to, like I said, get 50%, means half of the stocks in the basket of stocks, half of 140 something stocks are actually in bull territory, right? Both above their 200-day and their 50-day. So anyway, let's go through this and see what's going on with the sector. So the basic material sector, only 38% above their 200-day, 38% above their 50-day. And it looks like compared to last month, they've come down some. Telecommunications, 50% above their 200-day, only 17% above their 50-day. And I think that really says something here. Um, thing, okay, all right. I know why that's there. All right. Cyclical sector has been one of the worst performing sectors thus far. As you can see, month after month, it's just down, down, down. And keep in mind too that when you see these negative numbers, that means that it is down relative to last month. So the sector is down 0.12% compared to last month, and the same for May and the same for April. Again, cyclical sector has not been a great sector at all. Only 29% above their 200-day and 50% above their 50-day, which means that, and again, I'm not looking at last month to compare, but I imagine that 57 is probably a bit higher than what it has been, meaning that there are some companies in that sector that have actually come back a little bit from being down for so long. All right, consumer defensive. Okay, I get my thing. There we go. Consumer defensive, 67% above 200-day, only 11% above the 50-day. And it just tells me that compared to last year, these companies are still doing fairly well. But over the last couple months, they have really taken a huge turn for the worse. And so far, it appears that even though, the cyclical sector only 29% above their 200-day, when we look at the telecommunications, only 17% above their 50-day, tells me that it's not the worst performing sector, but it is definitely in there, right? So consumer defensive kind of in the same boat. Like more recently, only 11% above their 50-day, but 67% above their 200-day. So not the worst performing sector, but definitely not the best. All right, then of course, energy. We've said this over and over again, has been the best performing sector, probably for the past 6 months at least. Now I know I keep coming back to that every single time. 100%, every single company in our basket of stocks in the energy sector are above their 200-day, and 93% of them are above their 50-day. And that just means that they are just going gangbusters. And that is better than 81% of the market, better than 91% of the market. So, energy sector, of course, doing really well. That's definitely where you want your money. All right, financial sector. What's really interesting, I think, about this one is when you look at the relative performance, it's just been worse, worser, and then worsest, right? 32% above their 200-day, which is worse than 41% of the market, and then 62% above their 50-day, which is a bit better than the rest of the market. So this gives me some hope because what this means is that prior to last year, this sector has not performed very well. But more recently, though, we have some companies in that sector that have obviously done fairly well. But over overall, again, relative to themselves, it looks like they're just, down, 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 down. All right. All right, the health sector. This one's really for years been just kind of, I don't know how to describe it, but hit and miss. The health sector doesn't really concern itself with, inflation or anything. If there is, some talk of, persons, losing jobs, losing insurance, not able to afford elective surgeries, not able to afford plastic surgery, and also not able to afford medicine, this sort of thing, then we can see something really happening to the healthcare sector. But until then, I think we're okay. And with the unemployment rate where it is, again, it's really hard for me to see a recession. Doesn't mean that we won't be there or can't get there. It just means that right now, 71% of the healthcare companies are above their 200-day, 43% above their 50-day. What's interesting about this number is that that 43% above their 50-day is actually worse than the rest of the market, right? And 43% is really nothing to sneeze at. And what that means to me is that, again, the majority of the market is actually doing well relative to where it was a few months ago, right? If a sector like healthcare, where 71% of the companies in there are above their 200-day, which is a bullish indicator, right? And a little less than half of them are above their 50-day, which is a very bullish indicator, and that is still worse than the rest of the market. It means that, we're doing not bad. You know what I mean? It's not terrible. So let's take a look at the rest of these. Industrials, 33% above their 200, 17% above their 50. This may be the worst performing sector thus far because 33 and 17 series, 32 and 62. See, yep, 67. So you can't give it there. Can 57 can't give it there. Communications can't give it there. And then basic materials is like 38, 38. So industrials, um, well, I was going to say industrials before I saw real estate. So let's talk about this anyway. So industrials, 33% above their 200, 17% above their 50. That is one of the worst performing sectors thus far. And that does say a lot about where the economy is going. First, we saw consumer cyclicals, meaning that customers are not buying as many TVs. Now we're starting to see it in the industrial sector, which is companies' expenditures, right? These are the things that companies spend money on to make money. And if companies are not spending money to make money, at some point, we may see companies really start to lay off en masse. And that's really the indicator I'm looking for when talking about recession and things of that nature. As long as persons are employed and they're, generally making a bit of money, even though we may have negative growth in the economy, um, we're still okay. It's only when there isn't money being made, when there aren't jobs to be had, is when you really have issues. Currently, because we do have the money, I think it's more of a demand supply situation than it is really an economic thing. But we are starting to see the trickle down effects, right? First, consumer cyclical, and now industrials really says a lot. All right, and now real estate. Real estate, I think, takes home the number one prize for being the worst um, sector in the economy. Haven't seen technology yet, but I'm going to say this is probably the worst. 25% above their 200-day, 13% above their 50-day. Again, this speaks a lot to the consumer, but it also has a lot to do with interest rates. I've said it before, I'll say it again. When interest rates rise, real estate companies have to purchase loans at a higher interest rate in order to build, in order to make money. Also, too, because they're having to borrow at higher interest rates, they're typically going to sell their properties for more money, or they're going to want to loan it out for higher interest rates. And if consumers don't have the money for that, then guess what? Real estate companies go out of business and they can't make any money. Like I said, as of right now, everyone has a job. So even while things are a bit more expensive and there may be some complaining about it, they can still afford the things that they need, just not as much of the, what's the word I'm looking for? Luxuries, let's say, the luxuries. All right. Let's see technology. Look at this. Now, this is beautiful. This is what I like to see. This gives me hope. 33% above their 200-day, which is not great, but 67% above their 50-day, which means that these companies are coming back. They're coming back. They're not as bad as they were a few months ago. Technology is really at the crossroads of the consumer cyclical sector and the industrial sector because technology is something that both consumers and businesses have to purchase. And so when you see technology typically doing well, that's an indicator for the total market itself, which is why big cap tech gets talked about a lot in those circles. All right. Last but not least, utilities. Again, can't say enough great things about it. Utilities and energy have been the winners, um, period, for the last 6 months at least. 100% above their 50-day, 75% above, I'm sorry, 100% above their 200-day, 75% above their 50-day. So can't get any better than that. So utilities and energy is really where it's at. Let's take a quick look at these sectors individually. So as the utility sector, you see the MVPs. These are the companies that showed up on the best performing portfolios over the last 12 months. And this is a rolling 12 months. Okay. So every month, every time I report this, it's going to be a little different because one month falls off and a new month gets added. As you can see, it's really spread out amongst the sector, meaning that there really is no sector MVP. Basically, any one of these companies that you choose is probably going to perform fairly well for your portfolio. Looking at the average monthly return, however, again, is a rolling 12-month report. So every month is going to be a little different. Looks like ED, CNP, and EIX are top of the list as far as returns go. So if I had to just randomly choose one of these companies without looking at anything else, I would typically go for the company that has performed the best. Being that, like I said, pretty much any of these utility companies are going to do fairly well in our current market until something drastically changes, where persons aren't able to pay their utility bills. Those utility companies are just going to keep, basically printing money. All right, technology. We see that Cisco is the sector MVP. So 6 times over the last 12 months has been on the best performing portfolio, followed by Intel. We are currently in Corning, which is definitely not a sector MVP, and almost last on the list as far as returns go. Looks like Hewlett Packard just beats everyone, almost 3% return on average. And following that is IBM, which is just barely negative. So Hewlett Packard, the only one posting positive gains right now in technology. And again, this is a rolling 12-month thing. Okay, and we know that technology has not been the best sector to be in, but like I said, not doing bad right now. So, all right, let's take a look at real estate, where we know real estate is like one of the worst sectors to be in. Um, Currently, MPW, sector leading MVP. However, it does have a negative return. I'm really happy where MPW is, honestly. Really looking forward to purchasing more shares if, in fact, we're able to. I think it's a great company doing great things. They're definitely diversified. And so a lot of the things going on right now in the States won't really bother them too much. Looks like IRM and Welltower are the better performing companies in the sector. But I will say by far MPW is definitely sector leading MVP, followed by Annaly at the two spot. All right, industrials, Fastenal, sector leading MVP, followed by Paychex. Paychex is where we are. and is currently the highest average return on a month-to-month basis, followed by CHRW. Healthcare, another small sector. No real sector MVP. Like I said, healthcare has been a really weird sector for quite some time, and I will say that this probably because typically, when investors go into healthcare, they typically don't go into these big cap names. It's typically something like a bioengineering smaller company, and you're looking to have that one drug that they come out with that shoots the stock up like 50, 60%, right? I mean, it's very speculative, but not so much so for the persons who understand the molecules and understand the science. You know, they're able to really pick out a drug that they know is going to work, and they can actually make a lot of money that way. With this particular portfolio, this is, don't want to lose any money, don't want to speculate, and we want to make sure that we put cash in our pockets every month, if not every quarter. And so, what you're looking at here, just this group of what, I don't know, six or seven healthcare companies, these are the companies that are going to do that for you, right? They're not going anywhere. They have a steady flow of income. They're going to pay a dividend, right? And you're not going to lose any money. So with this short list, right? Walgreens, Pfizer, Merck, CVS, right? Um, Pretty much all these guys are performing fairly well. CVS you can say is a sector leader, but not by a lot, honestly. It's really kind of spread out. And then Pfizer is the leading average return, and it has everything to do with the COVID drug. Has everything to do with that. Um, Second to Organon's kind of a new company, so it's kind of unfair to mention them, but Merck is a second. So happy where we are. Really curious to see how healthcare turns out once we kind of get through this thing. All right, financial services is a huge sector, a lot of companies in there. Blackstone is the sector leading MVP. It looks like the better performer too at 2.5%. Regis Financial is where we are. We're just barely negative. And looks like following Blackstone would be EGR. Don't know a whole lot about those guys, but um, the finance industry sector has been really hit hard because going through these numbers, you see all of these negatives, and even the companies that aren't negative, they're barely positive, you know, and a couple of them are just way down. It's 4.5%, 50% last month. That's crazy. Um, and that's CM. I do know a tiny bit about CM, but not much. I think it's a Canadian bank. I may be wrong about that, but seeing stuff like this does excite me because when you see a company fall by 50%, either that is a sign that there is something really wrong and this company is, going out of business or something, or it's very possible that this is just people overreacting to something, right? And you can see over the last couple months, 5%, 9%, that's a crazy number. Yeah, this is a Canadian bank. I'm not sure what the story is or why um, this is happening. But again, stuff like that excites me because um, if you find a bank like that, that especially has performed well over the last 10 years, and then all of a sudden no one likes it, that's where you can make some money, right? That's where you go in and you get it for really cheap and you just hold on to it. And they're probably still paying a dividend too. So interesting stuff. All right, so that's it for finance. Let's look at energy. We already know that energy returns are going to be crazy. Like I said, best performing sector thus far. Valero is currently the sector leading MVP and at least top something for average return because the returns are just so crazy for energy. I bet you the average is about 4%. Let's see. Uh, what is it? 2.8. Yeah, so almost 3%. Um, and this is something that I've seen a lot of people do over the years, which is you find the sector that's working and you just put your entire portfolio into that sector, right? And so in a situation like this, you would definitely pick out a few companies in the energy sector, you pick out a few companies in the utility sector, and you just make money in those two sectors and nowhere else until things change and then you move on to a different sector. And that really works. It really does. I prefer a more diversified approach. That way, I don't have to be on time with decisions, right? I'm already in the energy sector, so I don't have to worry about getting in or getting out of it. I'm just already there, right? So anyway, leading average EOG, but just barely though. Like I said, there's a lot of guys here, 4.9, 4.6, 4.7. Um, energy sector again, just doing awesome right now. All right, consumer defensive, which is an interesting one. We know that it's not doing great right now, but typically the consumer defensive sector it stays stable because it's products and services that people have to have. Cigarettes are included in that, alcohol is included in that, and so they will always make money. But as we saw, it's definitely not the better performing portfolio right now. But yeah, not by a lot at all. 11% above their 50-day, meaning that once a company goes below its 50 and below its 200, that's a very bearish sign that this company is going to continue going lower. And right now, these companies are way above their 200-day, but below their 50. And so, what we may see at some point is those companies bounce off the bottom, head back to their 50-day moving average, or we can see them continue to fall and at some point fall below their 200-day. If that happens, that will be very bad for the sector. And I think that'll be an indicator that there is something really wrong with the economy as well. SYY is the sector leading MVP, but in reality, it's really spread out amongst the sector. So really, any of these guys will probably perform, fairly well. One interesting thing, though, I see here is that the better performing companies on average, the ADM, the BGs, are not in that MVP conversation. And that may be because these companies are not investable. Um, but either way, out of the companies um, that are investable, as far as I can tell, 1% is basically going to be the highest return, and that goes to Coca-Cola. All right, consumer cyclical, very small sector. Best Buy has been the sector leading MVP for a long, long time. They continue to be, but if you look at that average return, -3% for the month, which is actually not off from the rest of the sector. Honestly, we were in international paper. Again, -2%. PKG is something that I've been looking at for the last couple of months now. Barely positive, but at least positive. GPC, I've talked about them before. Barely positive, but positive. I think that as long as, like I said, consumers have jobs to buy used car parts, they're going to continue to do that. All right, telecommunications, we know it's not doing so great right now. BCE, British Communications, something, forget. Anyway, Canadian phone company, sector leading MVP, looks like the best performance on average too. Telus and BCE, yeah, both Canadian phone companies. AT&T, just something I always look at, negative, almost -3%, and that has been the case all year long. It's just I mean, look at this, 21% for May. I mean, it's unfortunate. I think the company is definitely trying to turn around. They've gotten rid of their television stuff, and so they're trying to become a phone company like their Canadian counterparts. But I just don't know when it's going to get there, or what it's going to look like when it's all said and done. Great dividend, paid on time every time. Really big dividend, by the way, but just the price performance is horrible. Rogers is where we are, as you can see, fairly positive, but positive. So not a horrible position to be in. Basic materials. This is always an interesting one because when you talk about inflation, you talk about commodity prices. Typically, when things cost more money, commodities cost more money. And so that usually bodes well for this sector. But as you can see, there's also obviously some worries about demand as well as expansion because in order to purchase these basic materials, you have to be building something, you have to be constructing something. And so when you have an economy that's not growing, there's no need to purchase copper other than maybe to replace things here and there, but not any huge, building projects, construction projects. So it, it's it is it's a real balance, right? Like I said, inflation is good because it creates a higher cost. So, a company like Southern Copper, where we are, the copper that they mine, the copper that they sell, they'll be able to sell it for more money, but you still have to have people that's purchasing it, right? And so it's a real balance. And I think that's why we see this sector do what it's doing, where it's really sort of in the middle. It's definitely not great at all, right? But it's not the worst either. Just kind of right there. So anyway, AEM, sector leading MVP, but CF, and again, I'm not going to even talk about SLVM because it's a brand new company. Um, Definitely leading the way as far as price performance goes. CF is, but I think CF may not be investable for us, and that's the reason why it's not showing up in the MVP conversation. All right, let's take a quick look at what has worked, what portfolio performed the best this month, and it looks like the alpha. And so, yeah, obviously over the last month, obviously the market has done really well because alpha portfolios perform best when the market overall performs best. And so, I think that's again really telling because if in fact there was a lot of volatility, if in fact there was a lot of money being lost, you'd expect to have the beta portfolio perform the best, right? Or maybe even like a dividend portfolio. And we do see some dark greens in that beta portfolio. We see some dark greens in the dividend portfolio. But overall, we really don't see this portfolio performing very well at all. Alpha, however, you know, so I think to plug this in. But the alpha, however, obviously is working because the market is flying higher. Oh, how I didn't have that figured out beforehand, I do not know. But figured out now. All right. Let's look at what else we got here. All right. So these are the companies in that alpha portfolio. Uh-oh. There we go. So Valero, of course. Blackstone, of course. Uh, Best Buy, you can definitely take that one out. Fastenal, why not? Intel, seen that. AEM, yeah. SYY makes sense. CVS makes sense. Alpha. PEG, I think that's a utility. MPW, real estate. All right, and then BCE for the telecommunications. All makes sense to me. It really does. Let's see overall though. So that was last month. Let's take a look now. Last 3 years, 72% is the return. M score, M score, alpha standard deviation, down standard deviation, alpha down moves, M score dividend. And so what I typically do, and it's important to discuss this because once everything gets reshuffled and reanalyzed, figuring out what portfolio to follow is the next question, right? And so what I like to do is I like to count how many times I see the word M score. I like to count how many times I see the word standard deviation. I like to count how many times I see alpha and so forth. And that kind of gives me an idea of what's working. And so it's kind of hard to see this without actually counting, but it appears that there's a lot of M score in here. There seems to be not a lot of down, but only a few alphas. Yeah, I would, yeah, without counting, I say there's definitely a lot of M scores, and that's what we've seen um, more recently. Quite a few down though too. One, two, three, four, five, six in the top, you know, 10 or 11. So, um, yeah, so down moves and M scores. Let's take a look now at the rolling 12 months. Alpha is number one, um, like number one, and I bet you that it's because there's a huge disparity between number one and number two, and I bet you this has everything to do with this last month. And the question is, which company was it that did this? Um, maybe it was a couple, but I think Valero is definitely a culprit for sure. Because the next best portfolio is 8%, and then it drops down to 6% after that. So this is definitely that 14% is definitely an outlier. Um, but it's still a stat. Like there's no question about it. In the last 12 months, the Alpha portfolio, if you purchase this portfolio literally 12 months ago and held it to the day, you will have returned for 14%. Um, all right. And then M score return alpha. So again, it's all these alphas. Alpha, alpha, alpha. So yeah, last 12 months and then last 3 years. Just want to go back and see where the alphas are. One, two, three. See, so when you look at the last rolling 12 months and you look back, then now all of a sudden, alpha makes a lot of sense. There's still some M score in here, right? Yeah, actually a lot of M score in here. Um, so anyway, that's kind of what we're looking at. And then let's see, as far as volatility goes, 16% up moves was the highest over the last, I think this is 12 months or 3 years. Can't remember honestly. But either way, um, that's the highest, I want to say monthly return. I have to double check that. And then the lowest low up moves again, which makes sense. So this portfolio, for whatever reason, has the highest volatility. I'm not sure what that means, honestly. Up moves means that the company performs best when there is a lot of buying and selling, high volume. So I think, Yeah, I think what's going on right now in this market is there's a lot of fear. Um, but we have to also go back because we have to talk about not only the fear but also the optimism, right? I mean, there was a lot of I even got a text message from someone who is not really in the market at all, but they were like, "Hey, I bought Amazon, right, because of the split." So while there is fear currently, there has been a lot of optimism too. And so when there's a lot of volume, when there's a lot of buying and selling, I imagine that uh, a portfolio that focuses so much on that large volume is going to be um, a winner or a loser. And so I think that's what we're seeing here. And funny enough, the same goes for the second lowest return, which is up moves, standard deviation, which is literally a portfolio that tries to capture companies that perform well with a lot of volume, but also don't move around a lot as far as the price goes. So it's kind of trying to balance it out a little bit, and that's the second one. And then Alpha Up is the third one. So again, all these ups, right? Up, 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 up. We know that this portfolio um, has a lot of volatility, meaning that it will perform really well, but it's going to perform really bad too. Um, let's go back to the high. So up moves, down moves. And so what's interesting about this is down moves are companies that don't, I always have a hard time explaining this. Companies that don't perform poorly with a lot of with a lot of volume. Kind of a double negative there. When there's a lot of volume, when there's a lot of buying and selling, these companies tend not to lose value. That's it. It's not saying that they go up in price. It's saying that they do not go down in price. Um, and so again, I think this is indicative of kind of where we are in the market, where it's very emotional, right? Like there's a lot of volume, there's a lot of buying and selling going on. You know, it's either we're very optimistic or we're very scared. It's not very even keeled. Um, and so I think to capitalize on that, you basically just kind of test the temperature of the market. How are they feeling today? Are they scared or are they happy? Right? And try to trade around that way. But I prefer not to mess around with that stuff. Just kind of stick with what's working, right? And that's where we're looking at, like I said, the last 12 months versus the last 3 years, and and just trying to make it happen that way. And when you look at those, you do see some down stuff, see a little bit of up, not a lot though. And then over the last 3 years, um, down, 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 down. But you don't see any up at all. And look at the smallest return, betas, of course. And last 12 months, smallest return, dividends, of course. This is interesting. Got the down moves in here. Dividend, down. A couple M scores, but the beta is with it, so pretty sure that has everything to do with it. All right. Let's see, one more thing. All right. Again, I don't think there's much that we can get from this, honestly. But I do think it's interesting to look at. Again, we're pretty much about 50-50 right now between 200-day and 50-day. Um, that is more than where we were last month. So the market is actually doing better than where it was last month, and that may be hard to tell, but it's true. Um, and then going back to December, which again is hard to believe. But if you go back to December and even October, right, we're better now than where we were then. So again, I see a lot of optimism. I don't see any need for panic, but I am glad that we are pretty much in cash at the moment, and looking forward to take advantage of some opportunities.